Der MSCI Emerging Market Index hat mit einem Plus von knapp 5% abgeschnitten. Das ist bescheiden im Vergleich zum MSCI World, der über 30% zulegen konnte. Was waren die Gründe? Interessanter noch, wie geht es in 2022 weiter? Erleben die Emerging Markets eine Renaissance? Wo liegen regional gesehen Asien, Südamerika die besseren Chancen? Wie müssen wir China in diesem Kontext einordnen? Diese Fragen wollen wir jetzt gleich bei Fonds im Fokus diskutieren. Herzlich willkommen dazu. Zugeschaltet aus Paris ist uns Emil Wolters von Comgest. Hello.
Morning, thank you.
Er ist seit 2012 bei der französischen Fondsgesellschaft. Seit 2014 ist er Co-Leiter des Emerging Market Teams. Bei uns im Studio ist Jan Richter, Senior-Analyst bei FondsConsult Research, den ich herzlich begrüßen darf.
Hallo, Herr Schmidt.
Hiermit darf ich an Sie beide übergeben. Ich freue mich auf einen interessanten und angeregten Austausch. Bitte sehr. Please.
Thank you for the kind introduction, Mr. Schmidt, and a warm welcome to Emil Wolter, who's joining us from Paris. Hello.
Hello.
Today we are talking about a potential new asset class, emerging markets ex-China. So let us start with a simple question. What's the weight of China within the MSCI Emerging Markets Index?
At the end of December 2021, China had a weight of approximately 33% in the broad emerging market index, so representing roughly a third of the overall asset class.
And why do you consider this a problematic weight?
I wouldn't say it's problematic. But you know, it's obviously a high weighting. The reason why we think it's worthwhile for investors to perhaps consider the asset class excluding China is that this weighting is not really likely to fall materially over time. In fact, it might go up quite a bit more. And we are finding that many investors increasingly are looking to treat China separately, and there are probably some good reasons for doing so. Which means that if left to itself, increasingly China will more and more dominate the emerging markets asset class, and perhaps giving investors less exposure to some of the other countries, which are also very interesting.
So what's then your solution to this perceived problem?
So what we are finding is that increasingly investors find it interesting to make a discrete allocation to China. In other words, treat it the same way they may treat America or Japan. And then on the other hand, they might still want to have exposure to emerging markets. And so a few years ago, we began a project where we are incubating a portfolio which invests in emerging markets excluding China. So it has all the countries except for the big one.
But doesn't removing China lead to new problems? Like then you have high exposure to South Korea and Taiwan, and you are very exposed to the semiconductor cycles through Samsung and Taiwan Semiconductor?
It's true that it creates a different index with different levels of exposure. I think it's still a more diversified index, and I think it's still an index that gives a more broad kind of representation of the different places. Clearly, emerging markets is not a homogeneous asset class in the same way that we find, let's say, Europe or the United States of America. But therein lies some of the opportunity. And yes, you're right. Today, Taiwan and Korea are quite high weightings, but equally you would have exposure to different type of countries at a different level of development, whether you're thinking about Brazil, South Africa, Russia, and so forth.
So then let us talk about your fund. So who are the people who are responsible for managing this fund and how they do work together?
On a day-to-day basis, there are basically three people who are driving our efforts on this portfolio. That's Slabbert Van Zel, Abla Balakdar, and Adam Haku. And each of these people have quite a long experience, both with Comgest and in some cases also outside of Comgest. And they bring each expertise and special knowledge about different companies in different parts of the world. In addition to the three of them, I work with them in terms of oversight and longer-term strategy. We are, again, as I say, incubating this portfolio. So for the moment, we are mostly running it with internal funds from Comgest, but we believe that over time, it has a lot of potential and it is interesting to quite a high number of our clients.
It seems that you have just recently been added to the lineup of the fund managers. So what's behind this move?
I think actually I've probably been on the lineup all the time, but as I say, I'm less involved in managing the fund day to day, which is really handled by the other three. And I'm more assisting in terms of, let's say, bigger picture and resources and oversight.
You mentioned that the fund has been incepted about three years ago. So performance in 2019 and 2020 was more or less in line with its benchmark. But last year it underperformed about 10 percentage points. So what has been the problem last year?
2021 in general, as you probably also know, has been a more challenging year for many of our funds in emerging markets. There's a couple of factors that are worth highlighting from my point of view. First of all, 2021 was a year of a cyclical recovery. So that meant that a lot of the more economically sensitive stocks in the market did extremely well. In particular, you would find that energy had just a great year. And of course, we remember that the oil price was almost negative in 2020, and then suddenly it was $70, $75, $80 in 2021. So there was a very large level of, let's say, positive earnings growth for that sector. The same thing was true in other sectors as well, such as shipping, such as shipbuilding, such as various parts of materials, mining, and so forth. Now, these type of companies are not typically companies that we invest in because we prefer businesses that are less sensitive to the outside environment and kind of can do well despite of the economy rather than because of it. Of course, we don't mind if they benefit from a strong economic environment, but we want to be comfortable that if the environment isn't strong, they can still do well. So if I look at the earnings growth of the portfolio compared to the market, the earnings growth was quite a bit lower because we had no exposure to the old sectors. And I think that was a disadvantage last year. The other thing I would say is that the portfolio does have a fair amount of exposure to the financial sector. Now, within the financial sector, there was a similar story going on in as much as banks had a strong recovery year last year. The way that banks had a strong recovery year was that in 2020, they had to make quite a lot of provisions because they were faced with this situation of the general economic lockdown, which of course is an unprecedented event, at least outside of wartime. And in 2021, they rolled back these provisions and they had a big profit boost. But the exposure that the portfolio have in financials, which is through companies such as Sanlam and Discovery, other insurance companies, these insurance companies did also take provisions in 2020, but they have not written back those provisions yet because they are still going through, let's say, the full implications of this pandemic. And that's because, of course, when you're in life insurance, there has been some impact to your business because unfortunately, people died during the impact. So the recovery in life insurance is taking a bit longer than banks. And that meant that our performance within this industry, within this sector, was weaker than that of the index.
Okay, so you are then quite comfortable that your investment approach, so your quality growth approach, will work better this year than last year?
Well, I would suspect so. I think the important thing here is to keep in mind the long-term perspective. So what this portfolio does, just like all the other portfolios at Comgest, is that it invests in quite a small number, quite a select group of high-quality businesses. And we think ourselves really as owners of these companies. So it's not just a piece of paper that's a share. It's actually that we have a small slice of the business. And these businesses have grown. They're doing well over time, but obviously the market's perception of them may change. Last year, the portfolio grew its earnings 30%, but as I said, the index grew its earnings quite a lot faster because of the cyclical industries. I think the index grew its earnings almost 90%, so exceptionally high. This year, coming back to your question, that will normalize. Earnings are expected to grow much, much slower. In fact, hardly expected to grow in 2022 for the index. I think at the moment, consensus is for 2% growth in earnings. But the portfolio and the high quality companies that we own will just continue to chug along, and they're expected to grow their earnings at about 16%. So you can see that whereas we were at a big disadvantage last year because of the cyclical boost, further exaggerated by the, I would say, exceptional impact on the insurance companies that I mentioned. In 2022, it will be a bit more normal. Our portfolio will keep growing and the market will slow down.
So that means that your portfolio has quite significantly derated last year and is now, compared to its history, very cheap?
It's pretty cheap. I mean, the broad market also derated last year because obviously it wasn't up 90%. So it's not unusual in the first year of a recovery for the stock market to derate, but that has also happened to our portfolio. You're correct. In general, I don't think we need the portfolio to really re-rate or derate to represent a good investment. Emerging markets are not very expensive compared to their history, and they are outright cheap compared to other asset classes, which I would consider an advantage as developed market interest rates go up. But in general, I would simply hope for the fund, and this has been the case historically across other funds at Comgest, to deliver returns over the long term that mirror or are very similar to the earnings growth. If that happens, this will be a very good investment. For the next 5 years, we're expecting our companies to also grow around 16% per year. So you can see that if we just do that, nobody's going to go hungry.
You're purely bottom-up manager, just looking at the fundamentals of the company, so you don't have a macro view on emerging markets or which region will do better this year or worse?
No, I think that's generally speaking right. We will kind of buy a company anywhere if we have conviction that its franchise, which is another way of saying its competitive position, is durable, is unique, and is sustainable. And if that franchise is being put to work in a way whereby earnings can grow consistently, not necessarily at the fastest speed in the next 12 months, but continuously over the next 5 years and hopefully over the next 10 years, and then we will buy the company. Of course, we have to be honest and say that because our asset class is not homogeneous, because there's a huge difference between the different countries, we do have to think a little bit about currency exposure in the short term. And, it's true that over the last few years, some of the emerging market currencies have been extremely weak. We tend to think that, quite a lot of this has already happened. Of course, the fact that things have moved in a certain way in the past doesn't mean they can't continue to move in that way. But when we look at the current account position of many emerging markets, we find that they are much more robust than they have been in the past, even fragile places like Brazil and South Africa. And when we look at the interest rate cycle and inflation dynamics, you will see that emerging markets have already been in a tightening cycle for the past 12 months. I think we had a record number of interest rate increases in emerging markets since 2007. Last year, there was 84 interest rate increases across emerging markets. So without going into too much detail of the macro, it is not the primary thing we do. The main thing we do is finding great companies and then try to grow with them. But we may adjust our exposures a little bit depending on whether the wind appears to be in our face or in our back.
When I have a look at your portfolio, there's also some exposure to non-benchmark countries like Vietnam or Japan. So what's the story there?
Well, look, I think Vietnam is officially classified as a frontier country, but it could just as well be an emerging market country. We are excited about some of the businesses that we have been able to identify in that place. I think it's a classic case where, you can find good companies, but you also do have a tailwind from an economy which is quite well positioned against the changes that are taking place in the world, whether it's China kind of migrating away from low-end manufacturing, whether obviously it's a response to tariffs that have been imposed on China, and also because of the education and the opportunities that presents itself in the country as a result of a young demographic and a kind of a good policy to support the inputs of growth. So we have some exciting businesses in Vietnam like Mobile World, which is a sort of omni-channel retailer, or Vietnam Dairy, which is the biggest kind of dairy business in one of the biggest dairy businesses in Southeast Asia. And we think it's a great country to invest. In Japan, we don't actually invest because, of course, Japan is not an emerging market, but we do own a Japanese company which derives literally 90% or 85% of its income sales from emerging markets, and that's Suzuki, which is the primary owner of Maruti Suzuki, which is India's largest auto manufacturer and auto brand.
When I look at the portfolio, is it structured around some themes, or is it just fully bottom-up? Because I think there's a team like financial inclusion, infrastructure investment, so there are different teams, and then you're structuring around the portfolio.
You're right, but I would say that it's not really necessarily that the themes comes first. It's sort of that ideas can cluster in certain parts where we basically end up finding more opportunities. And so, financial inclusion, as you reference, has indeed been a theme for us for a little while. We have seen a middle class emerge in emerging markets, of course, over the last 10, 15 years. These people have grown to achieve a certain living standard. Now they might own a house, they might own a car, they go on holiday. Obviously, they are keen to ensure that those living standards are maintained. And as they accumulate a bit of wealth, as they get these higher living standards, they need to take some steps to keep that. And that includes managing your savings. It might include subscribing to insurance policies, like I mentioned before. And of course, it includes starting to planning for retirement. So taking into consideration pensions and other things like that. So there are a number of businesses within our universe that benefit from that, but typically what we found catches a lot of this theme is in the life insurance industry.
And I think at the beginning you mentioned that currently the fund only has mostly some internal assets, so it's around $3 million, I think. So what do you think could be a trigger that outside investors will start looking at this asset class with more interest? What would you like to tell them? Why we should at least consider this asset class now?
I think it's always difficult to argue that the loser is going to be the next winner. But the reality is that the last 10 years have been quite difficult for investors in emerging markets. In fact, it's been quite difficult for investors everywhere outside of the US. But I suspect the next 10 years will be different. I think the constellation for investment returns in emerging markets are very good today, not least because it's been so bad in the past. The growth in this asset class have continued. It hasn't been stable and it hasn't been as high as it were in certain periods in the past, but the good companies, the type of companies that Comgest invest in, have kept on growing their earnings day in and day out. And these companies, like you mentioned before, today are a little bit off the radar of a lot of people, and they're kind of underappreciated, which represents an opportunity. So I think, in general, what will be a catalyst, for lack of a better word, or a reason for coming back, is that the asset class has got good growth prospects, it's attractively valued, and people are not that interested. So the positioning is quite light. So this means that the money is somewhere else and it can move this way. I think why would you want to invest in this particular fund, let's say, or another fund which is focused on emerging markets, excluding China, is most likely to happen because you want to come back to emerging markets, or you're already in emerging markets, but you want to control your exposure to China on the one hand, which is really becoming more and more of its own story. You can also see how China is increasingly focused on its own internal dynamics compared to its in relationship with the rest of the world. And that's on one side. And then on the other side, you have this broad story of continuous development, of positive demographics, and of a catch-up, if you like. And that, I think, is what you can get with this portfolio.
Then thank you for your closing remarks and your interesting insights into this topic. Very appreciate your time. Thank you very much.
Thank you so much.